Self-employment looks free and flexible from the outside, but financially it is very different from a job. There is no fixed salary, no guaranteed income, no paid holidays, and no company benefits. In 2026, more people are working as freelancers, business owners, content creators, and online service providers than ever before. But most of them struggle financially not because they are not earning enough, but because they don't have proper financial planning systems in place. Irregular income needs a different money system. The biggest challenge for self-employed people is inconsistent income. Some months are great, others are slow, and sometimes income is completely unpredictable. The mistake most people make is treating irregular income like a regular salary. Instead, self-employed individuals need a buffer-based system. This means separating money into categories immediately after earning. One part goes to expenses, one part to savings, one part to taxes, and one part to reinvestment. Without this structure, money disappears quickly during good months and creates stress during bad months. Separate business money from personal money. One of the fastest ways self-employed people lose control of their finances is mixing personal and business money. When everything is in one account, it becomes impossible to track real profit. A simple rule is to always treat your income like a business first. Even if you are a freelancer or solo worker, you should still think like a business owner. Business income should be paid to yourself as a salary, not spent directly. This creates discipline and clarity about what you actually earn. Build an emergency fund first. For self-employed people, an emergency fund is not optional. It is survival. Since income is not stable, having savings that can cover at least 3 to 6 months of expenses is critical. Without an emergency fund, any slow month creates stress, and that stress leads to bad financial decisions like borrowing or overspending in good months. An emergency fund acts as financial protection and gives mental peace, especially during uncertain periods. Tax planning is not optional. Many self-employed people ignore taxes until the end of the year, and then suddenly face financial pressure. Unlike salaried employees, taxes are not automatically handled for freelancers or business owners in many cases, which means planning is required from day one. A smart strategy is to set aside a fixed percentage of every income specifically for taxes. This money should never be mixed with spending money. Treating taxes as a separate category prevents financial shocks later and helps maintain stability throughout the year. Income diversification is a must. Relying on a single client or a single income source is risky in self-employment. If that one source stops, income stops instantly. That's why successful self-employed people always build multiple income streams. This could be different clients, multiple services, digital products, passive income, or investments. Even small secondary income sources reduce financial pressure and increase stability. The goal is not just to earn more, but to reduce dependency on any single source. Reinvesting in skills and growth. Many self-employed people make the mistake of only focusing on saving money instead of growing their earning ability. But in reality, the fastest way to increase income is through skill development and reinvestment. A portion of income should always go into improving skills, tools, marketing, or systems that increase future earnings. Self-employment is not just about working harder. It's about increasing value over time. The more valuable your skills become, the higher your income potential grows. Control lifestyle inflation early. When income increases in self-employment, lifestyle often increases at the same speed. A few good months lead to unnecessary spending upgrades like expensive gadgets, rent increases, or luxury habits. This is dangerous because income is not guaranteed. Smart self-employed individuals keep their lifestyle stable even when income grows. Instead of upgrading lifestyle immediately, they upgrade savings and investments first. This creates long-term financial strength instead of short-term comfort. Plan for retirement yourself. Unlike traditional jobs, self-employment usually does not come with retirement plans or pensions. That means retirement planning is fully your responsibility. This requires long-term thinking. Even small, consistent investments made early can grow significantly over time. The earlier someone starts planning for retirement, the easier financial freedom becomes later in life. Separate profit from spending money. A major mindset shift is understanding that all income is not spending money. Many self-employed people treat every payment they receive as available cash, which leads to financial instability. Instead, income should be divided into clear purposes: operating expenses, personal salary, savings, taxes, and investments. Once money has structure, financial control becomes much easier. Even if income is irregular, avoid emotional financial decisions. Self-employment can be emotionally challenging. Slow months create fear, and good months create overconfidence. Both emotional states can lead to bad financial decisions. Fear leads to underspending on growth, while overconfidence leads to overspending on lifestyle. The key is to make financial decisions based on systems, not emotions. A fixed financial plan should guide actions regardless of monthly income changes. Final reality for self-employed financial success. Self-employment can create unlimited financial freedom, but only if money is managed with discipline and structure. Without planning, irregular income becomes stressful instead of empowering. Financial success in self-employment is not about how much you earn in one month, but how well you manage income across many months. Stability, consistency, and systems matter more than sudden high earnings. When financial planning becomes a habit, self-employment stops feeling risky and starts becoming powerful. Like and subscribe and turn on notifications so you don't miss more videos about personal finance, money habits, and building long-term wealth.